De-dollarization, what is it and why should you care? Welcome to the Lowdown. Everybody, welcome to Lowdown. Today we're going to talk about a question we get often, and joining me today is Chris Roberts. Chris, before we get into this question, why don't you give us a quick market pulse?
Well, thank you, Mike. I know we're going to primarily discuss the U.S. dollar today, but we felt it would be important to give at least a quick market pulse. So, hey, on the bullish side of things, we've obviously experienced, the pretty swift rally. The rally's continued since I think the last time I was on the show, and really a lot of that's been driven by Q1 earnings, right? They've come in above expectations. Granted, the hurdle was set pretty low on that front, but that's really what's supporting the strong valuations or the rich valuations, despite the rapid rise in interest rates. Now, while earnings have been pretty good, we've got a number of bearish indicators we've been talking about a lot in the last few months, and now they're coming to fruition. Things like, they got the GDP numbers recently. They came in well below analyst estimates. Mm-hmm. We've just got general slowing economic activity, business investment. If you look at different banking indexes, notwithstanding the crises going on in some regional banks, but just the use of loanable funds, right? We've seen a plunge in business investment and their uses of lines of credit. That could partially be because, the cost of capital has gone up, but then also not a lot of people are investing for, long duration investment, so to speak, company investing in something that may take 5 years to become profitable. Not really doing that right now in this environment.
Well, and the other one is, the consumer. I mean, the consumer, a lot of people say, well, it's stable, but what I think people aren't looking at is the consumer is borrowing right now. Mm-hmm. And so you're seeing delinquencies on 30 days. So that is a sign that you're seeing the consumer starting to run out of gas here.
Yeah, and we talked about that last time I was on the show, right? Mm-hmm. People are financing their lifestyles, combined with pretty strong balance sheets coming out of COVID. That's since subsided, and now, like we said, they're financing their lifestyles in an increasingly high interest rate, or an increasing interest rate. And then, of course, we're seeing weakening, contraction in all the leading industrial manufacturing indicators. We've talked a lot on this show about why those are good leading indicators. We've also seen just generally the rally's been there, but there's been a lack of breadth, right?
Yes.
We're companies that have reported good earnings. Yeah, great. They've stayed pretty stable, but then we've seen large mega cap tech, for example, really going a significant rally this year, partially supported by the expectation of a pivot or pause in interest rate policy, and then also the artificial intelligence boom that's emerged over the last few months.
Well, there's really about 7 names pushing the S&P higher, the S&P 500. So if you just think about it, that's a very narrow scope of what's driving the market right now.
Exactly. Your Googles of the world, if you will. Mm-hmm. And then, of course, we've had ongoing volatility in the banking environment. While it's not the primary topic of today's show, I know that we're recording this as Powell's speaking, but he once again reiterated banking resiliency. We think that these are still isolated events, but you can't underweight the fact that these 3 collapses that we've seen are the equivalent in the size in terms of dollars to what we saw 15 years ago in the Great Financial in 2008. Now, granted, how many more dollars are in the system today versus 2008? Exponentially more dollars. So I don't think comparing the size of these collapses with 2008 is a good comparison. Plus, Washington Mutual is still the largest bank collapse ever. But I think that this goes back to, I think last time I was on the show, it goes back to a lack of diversification amongst collateral and lack of diversification amongst consumers, right? And that's the primary reason why these 3 banks have failed. That's, of course, creating a lot of downward momentum in markets. And then lastly, of course, we've got the debt ceiling fight, right?
Yes, of course.
Raise the roof, if you will. And so I think that actually provides a great transition into our primary topic today, which is de-dollarization. And I'll let you pick it
Well, yeah. So this is a question we've been getting quite a bit, and I just want to say, it's one that I've gotten throughout my career. As a matter of fact, let me just kind of point out, in 1997 is when I first got into the career, and I was reading a book called The Coming of the Dollar Crisis, okay? Now, that was talking about dethroning the dollar. This is something that's come up quite a bit. And if you had followed that book or listened to that book, you would have missed out, because the dollar did the complete opposite of what the book suggested it was going to do for at least almost 2 decades.
Yeah.
And this is something that's a very, very long-term trend, but let's kind of maybe get into a little bit of, in depth of why right now, why is this popping up again?
Yeah.
What is creating that? I thought maybe you can add some color to that.
There's a number of reasons why it's coming up again. Some of them are the same reasons it's come up for the last 20 plus years, right? But first and foremost, in the near term, a lot of folks have reached out. They said, hey, dollar's losing value, Chris. Well, why is that, so to speak? And ultimately, I think it's important we frame things from where we've been, right? Ultimately, the Fed was the first one to start the significant fight in combating inflation relative to other central banks. They started hiking rates first. That put a lot of gusto behind the U.S. dollar last year. Reached almost its all-time high and peak if you look at, let's say, the dollar index, if you will. And then, of course,
that attracted capital and made the dollar go higher.
Exactly, right? If I can get more return on my dollars by investing in treasuries, right, versus German 10-year bonds, then I'm going to go buy treasuries. That's because the Fed's taken the cake here in raising rates first, and now the expectation is they'll be the first to pause and pivot. So that, of course, has created downward momentum on the U.S. dollar, just purely from a supply and demand mechanics, so to speak. But just keep in mind here, again, frame everything here that is what we saw last year. The dollar had not reached that point since the early 2000s, and we are still, as we record this episode, dollar index is about where it was at the end of 2002. Okay. So we still have likely, some room to fall, and really a return to normalcy is would be much appreciated, for international economies. And I think that kind of segues into our next point about how a strong U.S. dollar affects things domestically and internationally. But I'll let you jump in.
Well, and just I think another thing, maybe just to kind of put some context on the dollar. For one, I think is responsible for about 80% of global trade, right? But how did we get here? I think many people have the wrong idea. They think that the world was just kind of forced into using dollars. But if you think about it for a minute, I mean, if the U.S. dollar, what other country can absolutely absorb the deficits, right? Yep. There's no other country that can take on a deficit like the United States. And so that is one of the reasons why you've seen, a trade done in dollars. And so I just think it's not a forced situation. It's just, there's no other country that can run deficits the way the United States can. And I think it's a huge thing to really understand why so many dollars are used in trade.
Right. And speaking of trade, right, we all think that the strong, really robust, strong dollar is nothing but positive, especially for us domestically. And I would argue that may not be the case. I mean, look, domestically, right? If the dollar is strong, that makes U.S. businesses less competitive overseas, right? Now, there's a number of ways to offset that trade imbalance, which we do. You talked about deficits, but at the end of the day, it still is hamstringing U.S. businesses from ultimately being as competitive as they could be. But on an international scale, this overwhelmingly strong dollar has really massive implications, right? It causes inflation because U.S. goods cost more, right? You got to convert more domestic currency to get an equivalent level of dollars to buy that good. Also, most international debt is denominated in U.S. dollars, which dollar goes up relative to your currency, takes more of your currency to pay those interest payments, right? It's like a variable rate credit card, like you had said when we were coming in today. And then just generally lower gross profits, overseas. So, we have to keep in mind that while, hey, we love the United States, we're only a small section of the world economy, and we are the strong dollar is adversely impacting the supermajority of people, on this planet, and there's opportunity to be had as we return, to normalcy on that front. Anything you want to add there, Mike?
Well, no, I think that's it's a good explanation, and I think now the other thing is, when I hear and have this conversation with clients about, their concern about the dollar being dethroned, I basically ask a question back. Okay, if you think that's the case and you really believe in it, then I ask you one question, and I ask everybody this question: what is going to replace the dollar, right? And I'm sure right now everyone's probably scratching their head saying, you know what, that's a great question. I don't have an answer. Yeah. And so let's go through it, because back in the day, I remember the last time this happened, the euro was the one that everyone claimed would replace the dollar. Well, how has that worked out? Not so well. And now probably one of the stronger economies out there, China, has prevailed since then. But the yuan, are you kidding me? Do you think anyone wants to do trade and the yuan, which is a Chinese
just
currency?
ask a business, would you rather transact in yuan or U.S. dollars? And right now, the overwhelming response is still U.S. dollars, because ultimately, in some senses, not fully, because we've explained why it's not, but the U.S. dollar is a much more, is a free market floating currency, whereas the Chinese yuan is ultimately controlled by a central government, right? And that
no one trusts.
No one trusts, right? So, I mean, if I'm a business, I'm just not at the point yet where I'm ready to transact in yuan. But another question I've been getting often, and this is so ironic because I remember having these discussions when I was a much younger guy with much more hair, with friends going back to high school about, do you know what the BRICS Bank is, Chris? I remember sitting on a beach in Galveston and a friend of mine, just one of the smartest friends I know, walked up to me. We were seniors in high school. He's like, hey, do you know what the BRICS is? He knew I was into finance then. And so we had a 2-hour conversation about it. But the BRICS is, of course, countries like Brazil, Russia, India, China, South Africa, and a few others joining together to kind of form a currency pact, if you will. And he'll ask me, well, is that a bad thing? Well, I think there's a good and a bad to that, right? The good thing is that it's showing that these developing economies are moving into the developed phase and wish to decouple themselves from the US dollar. I think in the long run, that's a positive side effect, right? We going from developing to develop. That's what we're trying to do on this planet. Have more people pull out of poverty and more countries go from developing to developed, right? Then on the other hand, I think, that introduces a problem we're seeing with the euro, right? Mm-hmm. It's ultimately a centralized currency amongst many countries with different competitive advantages and what have you. And that creates restrictions, right? It makes things restrictive for these countries, and then they have to, exchange money between each other, loan money. All these pacts are formed, right?
Debt to GDP had to be certain ratios that come in.
Well, just look at the euro.
It's called a Frankenstein currency.
Yeah, a little bit of Frankenstein. Yeah, exactly. So, it increases the likelihood of non-market manipulation. It hurts competition. So, on one hand, yes, we want to see these countries industrialize, develop, move to the next stage in their economic lifespan or life cycle, if you will. But I think that this approach could very well just lead to more of the manipulation we see currently domestically in China. So I don't think it's an overwhelming concern right now. And I think in the long run, it's probably beneficial, but there's certainly going to be some growing pains.
Well, Chris, what about this? Because this is another question we get that kind of piggybacks onto this is that, now you've got this whole, pact with China and Russia. And then now we've heard Brazil has entered that as well. What would you say to that if somebody's asking, well, now you're seeing these big major economies trying to trade between each other outside of dollars. Yeah. And what concern would you have with that?
Well, I think it's definitely a near-term response to the geopolitical tensions that we've seen stemming from the Ukraine, right? And I think that ultimately Russia's got some bargaining power here. China wants fossil fuels. Russia can't sell them anywhere else. They gladly sell them to China and exchange them in Russian rubles, right? I think that ultimately Russia's a pariah state. It's a dying economy. It's not a growing economy. They haven't made investments into talking about developing, right? I would consider Russia to be still a developing nation at this juncture. I mean, they just don't have a diversified enough economy. So if I'm China, I'm playing this game so I could play both sides. Mm-hmm. I can get cheap fossil fuels. I can try to act as the peacekeeper here, which is honestly welcomed because they're not going to listen to us. They're not going to listen to the EU. I think China has the potential to be a great mediator here.
Xi before anybody else.
Yeah, because he's able to sell him his cheap, sand oil. So, I think that, ultimately, I think this relationship we're seeing, especially between China and Russia, will eventually falter because China will realize in the long run, who's a better economic partner, right?
Yeah.
The West or Russia, which is,
who's buying my goods?
Yeah, who's buying my goods, right? And so, but I think they do have a position of power to play from here. This isn't a geopolitics show. I'm very passionate about this stuff, which is why I know you asked. But, it's in being neutral here, I just don't see how it's in China's best interest. I mean, even if they said, okay, yeah, we're going to take a giant landmass spanning across Russia and Asia, most of it's useless. So it's just an interesting question. But I don't.
Brazil, and other South American countries.
Well, and let's talk about that, right? Brazil and all them, they experienced incredible inflation last year because of the U.S. dollar rally. We've talked about that already. All their debts denominated in U.S. dollars. Dollar shot up. Brazil's economy went into the tank. That was two prongs. They've had hundreds and hundreds of percent of inflation, right? Yeah. And so it would make sense that a country like Brazil would want to decouple themselves from the dollar just for the sanctity of their country.
Relieve some of that pressure.
Relieve some of the pressure, exactly. So it totally makes sense. But, excluding the BRICS, right? is the world decoupling from the U.S. dollar a good thing? And I would just say in the long run, the answer is probably yes. The strength of the U.S. dollar has been, restrictive for American businesses, but it enhances the United States' place in the world stage, right? In the world political and economic stage. So I think a decoupling in the long run allows the U.S. dollar to be more market linked. It allows us to amplify our competitive advantages. And ultimately, and I've said this to many individuals here lately, I said, if you believe in U.S. innovation, which I do. I mean, look at the AI stuff.
Yes.
I mean, granted, SpaceX wasn't successful, but they just tried to launch the biggest rocket in the world into space, and that was pretty cool to watch at 8:15 in the morning as I'm starting my day. And there's 38, supposed to be 38 boosters firing, and there's 33. It was cool, right? And that's where that innovation's coming from. So I think in the long run, this allows American businesses to be more competitive. And I'll let you jump in before I jump to my next
No, I agree. And I think, just really kind of getting into, yes, it allows a U.S. business to be more competitive, but I think on a longer term basis, the concern over this, right? I mean, should you be concerned about this, the dethroning the U.S. dollar? And I just think that there is so many other things that are going to happen in the near term, the intermediate term. I mean, I told you, I read a book in 1997 about the dethroning of the dollar. This has been discussed even prior to that. Dethroning a currency is one of the longest trends to occur. Most of us probably won't be alive when the dollar is probably dethroned and something takes its place. And like I said, something, right?
Yeah.
What could that something be? What is that most likely? And by the way, I'll just add, the United States is going to make sure they have the best seat at the table and that they are part of whatever that may be. If it's a Bretton Woods, 3 or whatever it may be, there's going to be a negotiated position.
A watershed moment, definitely, in a transition, right? And so I think that the pace of the decoupling is going to be critical here. And I just want to add a point there. Right now, base case is the decoupling takes a really long time, like you're saying, Mike. Things like what we're experiencing right now, where Janet Yellen says, we're going to default by June 1st if we don't raise the debt ceiling. Those are the kind of things that cause the decoupling to accelerate and create more volatility. So while I can't control what Congress does, and you know this about me, Mike, I do write to my congressman because, quite frankly, I think it's kind of fun. And I keep all those return letters,
should, Chris, especially people your age.
Yeah, those candid stock letters they send back. Every once in a while, you'll get a real one, but in this case, it's those events can accelerate things. I mean, this always happens with the debt ceiling. The previous party in power passes a spending bill. Party in power changes. We don't want to pay for that spending bill, right? So we'll push that aside.
They argue for a couple of weeks, and what happens? They raise the debt.
Yeah, I mean, and of course, the 2011 event is very jarring, and we've seen something similar to 2011 that we're seeing now. The midterm election, change in the cycle, and then we're not going to pay for that spending anymore, and that was coming off the back of massive spending, TARP and what have you. So now. But back to your point, the world in general is inextricably linked to the U.S. dollar and U.S. Treasuries. I mean, if every single risk asset is compared to U.S. Treasuries in terms of what is the risk premium, right?
Yeah.
And so decoupling that entire underpinning of the world financial system is going to take a long time. And so we've talked about the debt links, the world trade currency, world commodity currency, with it, all oil trades on the dollar.
We're going to have many business cycles, booms and busts in a recession before that happens. And those are the most concerning things that people should be paying attention to.
And as we come to a close, I'll just say, changes to the status quo are scary, whether it be a small thing or a major thing. But I think it's important that we remember things don't stay the same forever, and it's not always for the worst, right?
Exactly.
Oftentimes change is for the better. I mean, that's really what I'm saying here is that, look, there's a lot of reasons to be concerned. A lot of reason to be concerned that none of us have any control over, but in the long run, I think this is a healthy transition.
Well, and because it takes a long time, and I like that you said it's not always for the worst, because right now the media and everything you hear about the dollar, I mean, these people come out and they want to make it sound like doom and gloom, and they're doing that to probably sell something or try to get you to buy something. So be careful with that. But you're right; it's going to take a long time, and there's lots of things that can be done within the portfolio in terms of managing and protecting yourself from that. There's lots of things that could be done, and also to benefit from that as well.
Yeah, and it's not so much the precious metals argument. It's more so just making sure you're geographically diversified. I mean, the diversification is a day one portfolio management technique. We've kind of fallen into the trap of being in such favor as Americans of domestic stocks because they have led things higher or led markets higher and the world economy higher for the last decade or really since the great financial crisis. We could very well be entering into a period in time where investing internationally and diversifying and geographically more significantly could benefit people.
The emerging markets international have been very, on the decline for almost a decade now.
Yeah.
So, probably a good trend there. And that's, again, back to staying well diversified.
And international performance has been great this year, both in emerging markets and in developed international for these exact reasons, right? Dollar comes down, it alleviates the pressure. So, we'll stay tuned on this.
Well, Chris, good to have you here.
Yeah,
I think we hopefully covered this question. And at the end of the day, should it be your near-term concern or intermediate? No, this is a long-term trend. So hopefully we cover that. Thank you for listening to The Lowdown.